Friends, today we will talk to you about the right investments, how to invest correctly, and we will analyze all the assets for investing and multiplying money. Since we know that if you just keep money under the pillow, they will be eaten by inflation. Very popular and good investor is Warren Buffett. So we'll talk about how to become as rich as Warren Buffett. Here are my recommendations. First, let's look at currencies. Investing in currencies can be attractive because of the opportunity to capitalize on currency fluctuations. This is especially true in an unstable economy when a nation's currency can lose value. Currency is one of the most liquid assets, which means that it can be quickly exchanged for other assets. This makes it attractive to those who want to be able to react quickly to changes in the market. The ability to capitalize on exchange rate differences is also a significant advantage. However, investing in currencies involves high risks. Exchange rates can fluctuate wildly, which can lead to significant losses. To successfully invest in currency, you need to constantly monitor the market and be prepared for rapid changes. Currency can be purchased through banks or exchange offices. There are also online currency trading platforms that offer convenient tools for analyzing and trading. The main risk in investing in currencies is the volatility of exchange rates. It is also worth considering the political and economic factors that can affect the value of a currency. The next type of investment is stocks. Investing in shares allows you to become a co-owner of the company and receive income from its growth and dividends. It is one of the most popular instruments for long-term investments. Stocks can offer potentially high returns, especially if the company is growing successfully. The ability to receive dividends is also a significant advantage. However, the value of stocks can fluctuate wildly, making them a high-risk instrument. To invest in stocks successfully, you need to analyze carefully and choose companies with good prospects. Stocks can be purchased through brokers on stock exchanges. It is important to choose reliable brokers with low commissions to minimize costs. Risks include market fluctuations, economic crises, and financial problems of companies. Now, the simplest but not the least important: real estate. Real estate is a stable and understandable asset that can generate rental income and appreciation in value. Real estate is less prone to fluctuations than stocks or currencies, making it attractive to those looking for stability. The ability to generate passive rental income is also a significant advantage. However, real estate requires a significant initial investment and ongoing management and maintenance. Properties can be purchased through real estate agencies or directly from developers. It is important to choose properties in areas with developing infrastructure to ensure liquidity and growth in value. Risks include falling real estate prices, tenant problems, and high maintenance costs. Now to the most uncommon assets. The first is crypto. Cryptocurrency is a new and fast-growing market that can offer high returns. Cryptocurrencies are decentralized and independent of banks, which makes them attractive to those looking for alternative investment vehicles. However, cryptocurrencies are also associated with high volatility and security risks. Cryptocurrency can be purchased on cryptocurrency exchanges such as Binance or Coinbase. The main risks include high volatility, the possibility of exchanges being hacked, and changes in legislation. And finally, diamonds. Just kidding. Precious metals. Precious metals such as gold and silver have traditionally been considered protective assets in times of crisis. They offer stability and protection from inflation, as well as high liquidity. However, returns on precious metals are generally lower compared to equities. Storage and insurance costs must also be taken into account. Precious metals can be purchased as bullion or coins through banks or specialized stores. Risks include fluctuations in metal prices and storage costs. To become a successful investor like Warren Buffett, you need to follow a few key principles. First, it is important to reinvest your profits. Buffett learned this fairly early on when he and a buddy bought a pinball machine in high school and used the money he earned to buy more machines. Second, you have to be willing to be different. Buffett didn't base his decisions on what everyone else was saying or doing. He worked in Omaha, not Wall Street, and refused to tell his partners where he invested their money. Third, it's important to know when to stop. Buffett attributes his success to a few key strategies, such as reinvesting profits and a willingness to be different. Or you can join clubs. After all, clubs are created for two main reasons: to earn dividends or to create an environment. Often people are embarrassed to admit that they are doing a club to create an environment, but there's really nothing weird or embarrassing about it. Many people realize that they need to surround themselves with certain people for a task. Famous and influential people also make clubs to surround themselves. However, if the initial purpose of making a club is to form their own entourage, it will be quite hard to introduce monetization into such a club. At the heart of the club should be a specific purpose, personal or commercial. Entourage clubs are unique and individual, and the goals for creating such clubs depend solely on their owners and founders. If, however, you plan to create a club with a commercial purpose that you will monetize, there are several models by which such a club can operate and make a profit. Major mistakes in investing include inflated expectations, lack of clear investment objectives, poor diversification, attention focused on a short period of time, and lack of control over emotions. Exaggerated expectations can lead to ill-conceived decisions and disappointment. Lack of clear investment objectives makes the investment process meaningless. Poor diversification increases the risk of loss. Attention focused on a short period of time can lead to panic selling. Lack of control over emotions can lead to impulsive decisions. To choose an investment instrument too, you need to consider several factors. First, it is important to use only legal, regulated instruments. Secondly, it is necessary to evaluate adequate profitability and not to believe promises of profitability above the key rate. Thirdly, it is necessary to diversify your investments and not to invest everything in one instrument, one country, one company, or one industry. In short, do not keep all your eggs in one basket. Fourth, it is important to consider the level of risk and personal involvement in investment management. Fifth, it is necessary to optimize taxes and protect capital. Investment tools include bank deposits, endowment life insurance programs, bonds, company shares, alternative investments such as collector cars and art. Bank deposits are suitable for short-term investments and can act as a capital reserve. Savings life insurance programs provide a financial protection plan and discipline to the investor. Bonds offer fixed income and can be used for retirement. Company stocks offer income from stock price appreciation and dividends. Alternative investments can offer long-term returns. I hope this video was helpful to you. See you soon.